us, but. Okay, so my question is, what, in your understanding, is the capital asset pricing model? What is it used for?
Es un modelo útil para establecer el costo de capital.
That's right. It's for finding the cost of capital for the firm. So we're finding the required rate of return that the firm will use for assessing investment alternatives that investors should use in assessing the value of its stock and so on. Okay, so that's what it's used for. Very good. So Sandra knows. How about the rest of you? Did you get that far? You need to tell me. If you don't answer, I'm going to assume no. Okay, very good. Alejandra's letting me know. Okay, Dailin. Okay, so I got to go back then. So I'm going to assume. Now, what about the rest of you? I only have 2 no's. There's 15 people in the class, I think. Everybody else knows the CAPM? What about the, what's the beta? Anybody know what beta is? What beta measures? That goes back into the statistics review. All right. So my sense is that you guys don't know. So where I'm going to start, I'm going to ask that, even though I had a date on this for last week, because you promised me you guys were going to study ahead. I know you have other classes. I know you have a lot of things to do, but I'm pretty much narrow it down to what you need for this class, right? Just watch the videos, you review the assignments here. I know you had my test, you had other tests probably. So I will have to start after the statistics review and ask you guys to work on that. And let's see. Did I add it to the wrong part? I think I added it to the wrong part. It's not supposed to go here. Okay, I added the headline to the wrong part because those are the let me fix that before I forget. I put the wrong title on these. Give me a minute. Okay, I put the headings on the wrong notes. So I start with the risk and return notes. So there's 3 sets of notes. And the first is just looking at estimating returns. All right, let me reload that. Do I need to start here? Can I have a vote, please? Should I start here or can I start in the second set of notes? Anybody else going to vote? Okay. Okay, so this is the first set of notes. So if there's anything, if you want to go deeper beyond, because I feel like I'm going to rush through this, but if you want to verify, you can go through the videos that I already posted. I'm going to say similar things. So what we're doing here, I'm going to go into my notes. Just give me a minute. I'm going to download this. Trying to be flexible. I really am. But we got to get this stuff done at the same time. Okay, let's just talk about this in an instant. So in the statistics review I wanted you to arrive here. This is the last page. These are the same statistics formulas that I had for what I called historical data. So this is data that's where each observation has the equal weight. But I cast it in terms of financial variables. So I used R instead of X and Y, and I use RM as X and RI as Y. And I do that for a very specific reason, because the relationship that we're going to exploit or look at is the relationship between market returns as measured by a broad index like the S&P 500. Oh, can you see that? My iPad? Let me make sure. Yeah. So these returns are an estimate from the S&P 500. It tracks the returns to the 500 top performing stocks, and it combines them into an index. And the stocks that are included, the companies that are included, change from, they change, not always the same 500 over time. But the point is, this represents a return to investment in risky assets and gives a sense of the performance. You can use it as a measure of performance of the economy, right? So this column is for a very specific security, a specific company and their returns. And so what we're going to talk about right now is, how did I calculate these returns? And so this is going to be the return over period 1. So maybe this was combining, is an average of returns that were calculated over that period, which could have been a year. It could have been over 3 months. It could have been over a day. Okay. So what goes into calculating that? And that's what we're going to look at now. So I'm right here. I'm just checking something. Okay, so this is how we think about doing this. What are the returns to a risky asset? The returns to a risky asset in dollar terms would be if the stock pays, if the company pays dividends to shareholders, so it's the dividend over the period. But sometimes the corporation doesn't pay dividends to shareholders. After it pays any bondholders that there are, the profits, the net profits, could be reinvested into the company to pursue or to expand other projects. And this may have a positive reflection on the perceived market value, and it may encourage investors to invest in the stock and bid up the price. So this could happen. And so there could be then, you may be holding a share with no dividend, but you could realize a change in market value, even though you're not going to sell the security. Again, just like that vacant terminal, you might not be renting it out, but it has value. And so there is the change in market value is a return to the shareholder over this period. So this is a notation we used. We want to convert that, as you saw on the list of returns, we want to make that a percentage. So we need to compute this relative to something. So, well, we want to make it relative to the original price. So let's say the percentage return would be taking the dollar return and dividing by the beginning market value. So I take each of these components and divide by the original market value. So I'm going to use the notation RT for returns at time t. And then divide by the original price. Divide dollar returns by the original price. So you could write that this way, because this represents for every dollar invested, these are the returns to shareholders over that period of time. So since it's a dollar, the return for every dollar invested, then if we take off the dollar, this is just the percentage in excess of that dollar, right? The percentage return. And that's what RT is. We can also rewrite that as in two parts. This is called the dividend yield, and this is called the capital gains yield. And that might be relevant to someone looking at returns, because in terms of taxation, capital gains can have a different percentage tax rate than dividend returns or dividend, dividends. So yeah, you got to pay taxes on that. And so that's a way to look at their percentage return over the period. Okay, do you follow this logic so far? So what I'm doing is going back into where did that data come from? So if you have information, this is saying on time series information, so data over time on the price and the dividend, then you can find returns. So you'll see there's a lot done with pricing data to compute these returns. Any questions so far? So everything I show you can't forget. You need to remember this formula, so you should probably write it out. Keep it handy on your formula sheet. And what I want to say are a few things that you've actually used this before, this relationship before, but this would be for each period, right? And if we make some assumptions, you'll see that you've actually seen this before, and I'll show you. First, I want to say something about this calculation. This is by taking the change over the original price, you're calculating the percentage change. This is the percentage change. I'll write it in words. You might have seen that in economics. Does that look familiar to anybody? Percentage change? Percentage change is usually associated with a growth, like a growth rate. So percentage change in GDP, right? The percentage change in productivity, right? The growth of the economy. So to calculate it, whatever you're trying to calculate the percentage change of in prices or in other indices, you just take the new value minus the old value divided by the old value. Some mnemonic to remember. All right, so if we take this very general formula for calculating returns to a risky asset, and you make some assumptions, let's assume dividends grow at a constant rate and assume that the required rate of return is constant. So if we assume that, we've basically seen this before, right? So if you assume dividends grow at a constant rate, well, that's just the growing. You have to think about the present value of future cash flows. The present value of future cash flows is the present value of dividends. And if you're told that they grow at a constant rate, then you'd use the growing perpetuity formula. Well, if you assume that cost of capital is constant, but you don't know it. So let's say we knew the price, we know the dividend, and we know I think I have to add that something about the dividend, but that we know, C1 known. So basically, you know that there's going to be a dividend in one period from now because I called it C1, the first dividend. So you will be given the dividend, you know the growth rate and it's constant, and you know the original price, then you could solve for I, correct? So rearranging, you could solve it like this. But let's go a step back and let's go back. Let's remove the layers of assumptions, right? Let's take away the assumptions. Let's loosen this up. To loosen this up, we call C1 the dividend at the time, so per year, right? For at any given time. We call the growth rate, well, if we assumed it's constant, but if it changes from period to period, we should write it like this. And the price we know last period, well, for generalizing and opening these things up to being each period, then we'll also write the original price as PT minus 1. So in terms of the subscript, whenever you look at this, don't get caught up in it. Just see this as, you can see this as T for today and T minus 1 as last period. Okay, so the point of this is not so much T, it's about the difference between T and T minus 1, that this is just one period ago. One period from now is T, or one period since T minus 1. All right, so what am I saying? I'm saying that this formula looks new. We've actually been using it all along until now, but with these assumptions. So if you open it up and loosen the assumption, you remove it and say, well, it doesn't necessarily grow at a constant rate. Well, the cost of capital is not necessarily constant. Well, I guess C1, we would have to know that, but okay, we're going to loosen up these two assumptions and we get something more general from year to year to year, right? So this is the more general. However, if we can make the assumptions, we refer to this as a very fancy name, even though it's the growing perpetuity formula. The fact that we don't have I and instead estimate it, we call this the dividend growth model. So this gets called a special name. Can't really, I'm just going to go like this. This is called the dividend growth model. So when you refer to when I refer to the dividend growth model, it's the same assumptions as a growing perpetuity to solve for the unknown I. So notice R is the changing return in each year. I is what we assume to be constant over a period of time. But they're both returns. Questions? I hope you guys are listening. I know you have other things going and you're probably working, but this is really to try and get you caught up and to save you time, if anything, that you don't have to sit and watch 9 hours of videos. All right, so we can take a moment and apply that formula. So reading this problem, suppose a stock has an initial price. So this is going to be PT minus 1 per share, paid a dividend during the year and had an ending price. Right, so that's the information we're given. This is the formula we want to apply. Try that. Excuse me a second. Okay, I'm back. So what'd you get? You have to divide by the old price. Julio's got it, but make sure everybody else can get the same number. So it's as simple as that. It's just reading enough exercises so you're comfortable interpreting what they're asking for. Yes, okay, perfect. Oh, I guess I have to do it here. So when you calculate the dividend yield separately and the capital gains yield, total return will be 12%. Dividends yield, which would be 0.84 divided by the original price, which is 42, gives you what? That's 2%, right? And then the capital gains yield is 10%. Because it's going to be the change in price. Is that correct? So the new price is a little higher, 46.2 minus the old price, 42 divided by the original price, 46.2. Oh no, it's lower. No, it's not. Initial price, 42. So it's not the dividend that is the return, it's mostly capital gains. And dial in. Do it again, dial in. I'll give you some time. Those three variables there. Get clear what they are. Got it? Good. All right, so what we've done is figured out how we get a return in a given year. So back to this again. So we basically got, or in a given period. So we basically calculated one of these. All right, so I taught you how to get one of these. I'm not going to talk about this. It's a little more involved and the level of information we need is greater. But we got one of these, right? And so what if I have a whole series? Like if I have the whole series, time series over a period of time, what do I want to do with that? Well, I'd like to summarize that information. And I could do that with a measure called the holding period return. This gives you what was your return over T years or T periods. So it should look familiar. It's just compounding, right? So for every dollar invested, what was the return over a period T? The only difference from what we were doing before is the return changes because it can be a different number over the period. So we're going to do an example in a moment. The other measure that would be interesting is to know over that period, what was the average return, right? So give people an idea of what was earned each period over that total T periods. So again, this should look familiar to you. This should look like the effective period rate, except the difference is that the returns change over time. And I'm still going to partition using the exponents, and not like in the exponents, I'm going to partition it not by dividing by T and then -1. This is known as the geometric average return, and it's very fitting with returns because we clearly we are used to compounding for every dollar invested. So this is the geometric average return. Now this is the simple arithmetic average return, and although it's if there's a difference between the arithmetic average and the geometric average, you should use the geometric average return. It better reflects, and I'm going to show you an example, it better reflects the returns over time per period. The geometric average return has a specific use, and we'll get to that as well. Everybody okay with my formula? We're going to apply them now. I'm going to take them, and we're going to apply them How did I skip so many? Okay, so we're going to apply them to this period of time. Now, this period was 1 minute, please. It's unpredictable. I don't know when it's going to do different things. Okay, so this is the period over the global the global financial market crisis, 2007 through 2010. Now, before 2008, when there was a mortgage-backed securities crisis, essentially, that had a global ripple effect through all financial markets, there was a return in 2007 that was like feeling it was coming on, right? The market is it's reflecting a downturn, right? This is 5.49% on average, and you'll see in my slides, on average, historically, in any given year, the average return is about 11%, somewhere over 11% in the US stock market. Well, this was below average, and then after the market crash in September 2008, the market dropped to 37 negative. What does it mean? For every dollar invested, people lost 37 cents. Okay, in that period. Now the question is, if they left their investments there, did they recover? So that's what we're going to look at here. Did they recover in the preceding years? So they would have had to realize these returns, you need to be invested in a broad index represented by a portfolio of diversified assets. Also, people can invest. You can invest in an index fund. that does that the fund creates the equivalent of a well-diversified portfolio, and you become part owner in the returns to that fund of assets. So this is the question, did they recover? So we're going to use first the holding period rate, then we're going to get an average return in each of the measures. So why don't you try that without looking at the answers and see if you can do it. Make this bigger. And it's doing that thing again. Julio gets 3.3 negative. Very good. I really recommend you try and calculate it. So you can get some feedback of your understanding, what that's asking you to do. So here you have, oops, why do I have so many repetitions? Oh, because I copied that there, so sorry. And then, so here are my calculations. The only thing you have to be careful about is this negative. And you should be okay. So, let me pull the data and bring it with me over here. Sometimes it works when I paste it, sometimes it doesn't. All right, so to put this in your calculator, see if I can do it without making a mistake. So I want to do this, so it's going to be 1.0549 times bracket 1 minus 0.37 close bracket times 1.2646 times 1.1506 equals -1. That's how you get it. Julio was wrong, but he was close, so I thought it was the right answer, but he's kind of wrong. It does round to 3.3, but I have a different number than him. Okay, so work at that. I'll give you a couple minutes. So I'm going to take the holding period return, which I just erased, and I'm going to put it to the fourth power minus 1. So it's going to be 1 minus 0.0330 equals to the power of 4 inverted equals minus 1 equals. So this is, Dailin, you are not right there, but it's good practice. You keep getting that answer. Something is wrong. Should I do it again? Just couldn't watch the video. It might be with you're putting the decimal in the wrong place for one of the numbers. Okay, so it's important, yeah, to practice that. And if you have problems getting the numbers on your calculator, well, you really need to get them on your calculator, but you could also opt for Excel. Excel will help if you're really frustrated, but you should practice with your calculators. All right, where was I? So I just got the second one. Do you want me to redo the first one? Okay. So 1.0549 times bracket 1 minus 0.37 close bracket times 1.2646 times 1.1506 equals minus 1. Now I got your number. So you're probably right. I probably did something wrong. Let me do it one more time because it does round up. 1 point, I might have missed a number, 0.549 times 1 minus 0.3. See, I put 3.4. I might have done that last time. 3.7 times 1.2646 times 1.1506 equals minus 1. Yeah, okay, so you're right. My number was off. I think I probably did that 3.34 rather than 0.37. Anyway, we have the video evidence. All right, so with that number, I'm going to add it to 1. And then I'm going to take it to the power of 4 inverted. And I get this number. And then I subtract the principal and I get this. And this rounds to negative 0.84, which makes sense. So if you compound negative 0.84% for 4 periods, you'll get negative 3.3%. Okay, that's basically that we understand. That makes sense. And then finally, if I was to average these numbers, so I could put them into my data key. I could put them here. Remember how to use this? So I'm going to put them in the data key. And, or maybe you don't remember. I'm going to make sure there's nothing there. So it's clear. If not, I have to hit second clear worksheet and then start entering my numbers. I'm going to put in, I'm going to enter them as decimal 0.549, enter down, 0.37 negative, enter down, 0.2646, enter down, and 0.1506. So people who took my stats class know how to do this. And I don't remember if I showed you last class. So I've put them in there, and then to get the average, dial in. It's close. but that's not it, but you're close. It's just a lot of decimals. You got to be very careful on entry. So I have my numbers. Just watch me do the average here. So I put them all in the calculator, and then I ask for the statistical results, and I get lin, which means linear, and it's going to give me the mean. And that's the mean. Did I have a chance to show you how to use the calculator last class? I have to check the video. Oh, good, Sandra. Thank you. All right, so one achievement is getting these calculations, and the next is the interpretation. So what did we find? We found that $1 invested in 2007 would result in a loss. For every dollar invested, you lose 3.3 cents. And on average, that's 0.84 cents a year. But the arithmetic average is 2.5. How do I reconcile that the arithmetic average is 2.5 and the GAR is 0.84? How do I reconcile it, and which one should I use? So if you had a chance to watch the statistics review, you know that the arithmetic average is very sensitive to extreme values. It gets pulled towards those extreme values. So you have 26 and 15 that is relatively extreme next to these other numbers, and it pulls this number higher than it otherwise should be. So we don't use the average when data conflict like this. So the GAR and the GAR and the arithmetic average should be the same. If GAR is not equal to the arithmetic average, use GAR, because it's not sensitive to extreme values, okay? Okay, any more questions about this here? It really makes a lot of sense. GAR is another measure for that's resistant to outliers. And it's particularly useful in finance because we understand returns and it's much more meaningful. So yes, thank you for the question, Mark. It's very important that we make that leap. If you calculated the median It should be different from R bar. The median of this data would be, if I rank this in order, it would be between 26 and 5. It still wouldn't be good. No, wait, because it would be, negative, yeah. The median would be between 5 and 15, so it wouldn't be good. GAR is better. So GAR is an improvement. All right, but that's a single value. That's a single measure. And we know there's definitely some volatility here. It's quite erratic. In fact, looking at returns as a measure of reward, we also need a measure of uncertainty of that reward, or the variability associated with that return. And you can see here, I've presented 3 different asset classes. You have risky assets as measured as by the S&P 500. You have what we are going to call the risk-free asset, the 3-month treasury bill issued by the government for borrowing from the public, and the 10-year treasury bond also issued by the government. So as issued by the government, these two are guaranteed. They're backed by the government. So that's why I refer to the short-term bond as risk-free, and you see it as the one that's closest to the 0 line in return. It doesn't vary wildly anyway, at least not like the others. I'm looking for the small, so it's this one here. Sorry, it's this one here. I'm tracing it. So it's not as wild, it's much more stable over time, right? Although we do have this year where there was the oil crisis. Okay, so that is the 3-month T-bill. Bonds are over this period, 80 years, are the other dashed line. This one in between, right? It's much more volatile, lots of changes, up and down, up and down. And the average is a little bit higher than, if you were to average out, kind of try to say where the average of all this movement is for the T-bill, it's lower than you would say the average for the treasury bond, that's 10 years. And then you have the very wild lows and dramatic highs of the S&P 500 over time. So this is data of percentage returns over 80 years. And this just shows that it's not enough to say what the return is. You need to mention the volatility, because at any point in time, you don't know where your returns would lie if you were invested in the S&P 500. So we want to get a measure of this uncertainty as the standard deviation. And I went through this in the statistics review, how to calculate standard deviation. And this is again for historical data. I use the symbols with the hats because these are estimates, just a sample of data. And I find out that once I get the standard deviation, and you should practice making these calculations, once you get the variance, the square root is the standard deviation. Now, to get this out of our calculator, let's do it. I already did it because it's already in my calculator. So I did the calculation manually. I wrote it up and I used tables to calculate it. I used several slides there, but essentially you can get it out of your calculator. I already have the data in there. If I scroll down, that is the standard deviation right there. 26.7%. Okay, so let's get that. Okay, so all this is just to get 27.7%. Is that what I said? Let's see that again, 27.7%. Yeah. So wow, so the expected return was in terms of how do I pair up my standard deviation? I do it with the return. If I take the average return, I get 2.5% over this range. And then I get the measure of risk or the standard deviation as 27.69. So if you watch the statistics review, what I do with the mean and standard deviation is I make an assumption of normality or symmetry in particular, and I use these to describe the spread of the distribution. I say that 2.5 is in the middle, and the rest of the data is spread out by this standard deviation. So it looks like you're going to be right into the negative returns just in one standard deviation. So this is like a 50-50 deal investing in this security. In this case, it's the S&P 500 over those 4 volatile years. So you must feel a little bit confused. Why am I mentioning this when I told you we're going to use GAR? We would use GAR in the case that there's a difference between them, but I'm trying to make a point about stock returns. So the point about stock returns is, in fact, if you can assume normally distributed returns, then you can take your arithmetic mean as the true mean, and you can take your sample standard deviation as the true standard deviation, and then estimate what to expect. In this case, most of the observations are within, like, well, just around 0. This is very close to 0. So within 27 or 25%, if I was to take this and subtract one standard deviation, I would be at negative 25%. If I added, I'd be at like 30%. So you're basically 50-50 that you're going to get negative returns. So even though I shouldn't be doing that with this data, I'm going to plot the normal distribution here and look at those returns and say some things about it. In general, returns to the stock market over a long period of time will be, they will have normal distribution. Okay, and I'll show you some examples of that. So let's use these numbers here that I'm going to show you how I calculate them and plot what the return should look like. So in the middle, we're going to put what we found over those years as 11.4%, and then go one standard deviation to the right and one standard deviation to the left. And so plot all the broad tick marks of this distribution. So this will be mu plus sigma. This one will be mu minus sigma. This one will be mu plus 2 sigma. This mu minus 2 sigma. This is mu plus 3 sigma, mu minus 3 sigma. Using the numbers here as computed from this period of time. So on average, the returns for the S&P 500 are 11.4%. But in any given year, you could have negative returns as I demonstrated. I didn't say anything. I'm waiting for you to tell me the numbers. Let me see, audio's on. So what do you get? So if I add 19.7, I'm going to be at so I have some questions below. You just keep adding. You add mu plus sigma, mu plus 2 sigma, mu plus 3 sigma. This is mu, and this is sigma. And then you go mu minus sigma, mu minus 2 sigma, mu minus 3 sigma. So 11.4 minus 19.7 is negative 8.3, then minus 19.7 is negative 28, and then minus 19.7, let's read that up, 28 negative minus 19.7 is 47.7 negative. Let me know if I made any mistakes. So there we have the distribution laid out. It's a normal distribution because returns exhibit normal distribution over periods long enough within the last 80 years. And so let's see if we can answer the questions. What is the chance of positive returns? What could we say to that? So what did we learn about statistics? That 68% of the observations fall within 1 standard deviation of the mean. And then, so because of that, if that's 68, then this must be 34%. The chance of positive returns, we have to sort of figure out being like between here somewhere, 0, right? So positive returns would be somewhere in between these. And it's hard to know, but it's like between 50%, somewhere between 50% to do all of this, because this is 50% this way. But then up to here, it's another 34%. So the chance of positive returns are in a range of values, because I don't know where the 0 is. You could do this in Excel and find out where it was. You could use Excel and then the normal distribution and then these values to find out exactly. You want to do that? Yeah, so you kind of just want to divide this in half, but it's not exactly half, but yeah, so you could say, so because the word is approximately, right? So you could say, probability that the returns X are greater than 0. The chance that X is greater than 0 is between 50% and, let me say approximately 50% and like 66%. Add that 16, something like that. Like, it's hard. It's not exactly divided in 2, but it's more than 50%, but it's less than 70%. You could say, so that's just like this, all the way here would be 50 and 34 is 84%. It's not that high. But it's like 0 is somewhere here. Questions? Sandra, you still get it? You get it, or you're still unsure? So we just don't know where that 0 is precisely, but you want to do it in Excel so you feel better? We can do it in Excel. Let's try it in Excel. To do this in Excel, what we want to do, let's see if I can do it, because I don't know why that has a sound these days. We'll have to hear it for now. So I want the normal distribution. And I got to put in the value. So I'm going to put in 0. And that always gives me the value to the left. The mean is 11.7. And the standard deviation is 19.7. And I want to do it cumulative. I want the side, like on the left side. And why is it? No, I want to go the right side greater than, sorry. So this is going to give me always the left side. I'll copy the formula so you can see it. There's the formula for you. And so we need the right side, right? So we want to say positive returns. To do the positive returns, you take 1 minus. So was I right? Yeah, so it's like about 66, I said. So it's actually 70%, but not 80. Got it? Yeah, some people don't like approximations. You want the value, but there you go. So you could do that in Excel. If you took stats with me, I would have shown you how to do that. Made a mark. Anyway. I have to do this. Okay. All right. All right, back to the problem. So what's the chance that returns will be less than negative 30%? Do you want to try Excel and let me know? Try Excel and let me know. I'll leave up my Excel sample so you can see that. Why do I have sounds coming out of this thing now? What is the chance that returns will be less than negative 30%? So it's probably, you could see it mostly in the graph or the chart or the drawing, that negative 30 is just about here. And this marks what? This marks 2 standard deviations. Now I know at 2 standard deviations, between is 95%. So outside is 2.5%. So you should have learned statistics. And now you're putting it to practical use. I mean, it's all practical use, but I mean, in terms of business and finance investing. So the chance of less than 30% or negative 30% returns is small. It's 2.5%. And it's approximately, so I'm using negative 28 instead of 30 negative. If you want to get that in Excel, let's see. I'm going to copy the formula. I'm going to change just the value X from 0 to be negative 30. And I said 2.5, but it's less than 2.5, right? Because I'm just doing an approximation. So it's like almost 2, 1.7. It's actually quite small. So that's to the left. Got it? So we did something fancy with the returns data. Should be able to interpret returns data. So over with an index that covers a broad number of securities over a wide range of time, we can assume normal returns and make predictions like this. So I'm going to say close to, because negative 30 is over here somewhere. And we actually got it to be that specific number. Are we done with this? You good? Can I move forward? No, I want to get out of here. Not good. So all I did was, I can't copy it. Anyway, I just changed 0 to negative 30. Okay, so So this is, in fact, the results of looking at the data from 1926 to 2008, so just before the crisis, before the market crash in 2007, or actually it includes it. And just that 1 year doesn't change the pattern dramatically. So average returns to large company stock have this normal distribution. This is much more spread out, and that's seen in the standard deviation calculation for small company stock. So there's more volatility, greater risk measured by the standard deviation, but an accompanying higher return. So looks like there's a trade-off. Let's see if it's consistent. Here is a lower risk and a lower return. So these are considered risky assets, one for large company and another one for small company stocks that looks much more volatile, very risky, but higher return. So we begin to see, and it is the case, that there's a trade-off. And the higher the volatility, the only way a stock will be invested in or company will be invested in if it guarantees a higher return. So the flip side of that is that investors in the firm will require a higher rate of return. So these are average because, as I argued, over a long period of time and with a broad class of assets, you can use the arithmetic mean and the standard deviation to estimate the measure of return and risk. Here is the histogram for long-term bonds, less risky. And these are corporate bonds. They're less risky than stock, but then also a lower return expected. Long-term government debt should be less risky, but it's very, very close here. You could argue there, you can determine if they're statistically different. Maybe they're not. So long-term 10-year, 20-year bonds, they require a higher rate of return than short-term bonds like T-bills because there's much more uncertainty packed in locking your money away for a long period of time. So we arrive at the Treasury bill. The Treasury bill on average has about 3.8%. The last 10 years before the pandemic, it was very, very low, much lower than this. Well, I mean, lower than this in the less than 1%. And the standard deviation over time, over this period, is about 3.1%. So this is the lowest risk, the lowest return, and theoretically, we will refer to it as the risk-free asset. So to be risk-free, then the standard deviation of returns to the T-bill are going to be zero. Even though there's a number here, in the theory that we develop, we're going to refer to its risk as zero. I'm going to use the symbol RF, although for returns in general, I'm going to use R bar and an I. So these are all R bar I up until here where I call this RF. And I don't put a bar on it because we're going to say it's relatively stable. Notice that T-bills, the return to T-bills is like a hedge against inflation, so that it outperforms or it overshoots inflation on average. So this is an incentive for investors and investment funds to hold T-bills. These are 3-month, 90 days, could be 3-month, 90-day T-bills that are without coupons. They just are discount bonds, and they capture the 3.8%. So it retains the purchasing power because it beats inflation on average. So there's the incentive for T-bills over time. So we're going to step away from this to say that all rational investors will invest in T-bills, but they have to be incentivized to hold, and they have to be incentivized to hold any risky assets. Now, how much they have to be incentivized by is known as the risk premium. We can calculate the risk premium for each asset class as RI minus RF on this table. So you're going to take each return arithmetic mean, each asset's arithmetic mean, and subtract the risk-free rate. Everything relative to the risk-free rate. So the first one, 11.7, minus 3.8. I hit something. Okay, do that again. 11.7 minus 3.8 is 7.9. So that's the risk premium. This is 7.9. I'll put it in red. For large company stocks, 16.4 minus 3.8 is 12.6. So it's that's the highest risk premium is with small company stocks, great volatility, and a company high return anticipated and delivered, right? Otherwise they wouldn't exist as an asset class. So then 6.2 minus 3.8 is 2.4. And 6.1 minus 3.8, 2.3. And we stop there. All right, so that's the risk premium. We'll talk more about risk premium in a bit. What I do next is I actually updated the tables myself, because this was from an old textbook, to include 8 years, so another 8 years of data. And did things change much? Is it relatively stable? And the thing about population data is it is relatively stable. Something to change a large set of data or population data. This is like a population of returns, right? It mimics a population to follow them for such a long period of time. And you see that this is very similar. The average return has gone down slightly to 11.4 by 2016. So it's incorporating that really bad set of years after the global market financial crisis. And I've calculated the risk premium for you as well. So this is just US common stock, government bonds, very small risk premium, and T-bills on average still about the same. They were 3.4, 3.8, now 3.5. So you see, this is considered roughly symmetric. I know it looks like, oh, is this skewed here? Well, no, if I smooth this out, we're comfortable saying it's roughly symmetric. And the returns, the center is above government bonds. Like this is more of the center for government bonds, and this is the center for common stock. So it's higher, but this is much more spread out than government bonds. And you can see that as the standard deviation is less than half. And here are T-bills, very stable, close to zero. It's a little bit, some few extreme values over there. And no negatives to this point, 2016. All right, questions? That's that. I think I did everything. So that is a review of the basics using financial data, introducing you to some things that you need to know, that the average return to the market portfolio is like 11%. Some of my earlier examples, I had like saying pension was invested at 12%. So that's trying to mimic, or it overshoots though this number. Okay, any questions? From here, we have, this is the data, sorry, let me go back to the notes. And I have some exercises. And I also introduced the UR case part 2. So let's see, I have a set of exercises here. Did you try these? Let's see, let me get the question paper instead. So which one do you want to try? Let's try like 2 or 3, not too many because we need to move on. Let's say 2. Which 2 would you like? So have a look at it and pick 2. Adamaris, for assignment 3, there's no option to validate the correct answers. Let me check was it due already? Once it's due, you should be able to see the answers, but not before. Let me see. Thank you for the question. I'm going to check what I did for you. Right, I have, but the practice assignments, you can see the answers, right? In terms of progress, okay, half of you guys didn't finish. So you need more time for assignment 3? I think you need more time for assignment 3. You don't want any more time, Alejandra? Oh, you can't see the solutions in the practice assignments? Is that what your no is? You should be able to see everything in the practice.
And more time would be great, Professor. At
Okay,
least one more day.
yeah. In terms of the practice, you cannot see your options. I mean, your grade.
I believe in the end you can.
You should for the practice, right?
Yeah.
Let me double check. So the practice, I want you to practice. So I had some trouble with the options on this thing. And it feels like they changed them. Practice. So edit all settings. It's the last one. I always have trouble with feedback. It says detailed feedback with solutions after the first attempt. Well, I have to turn this off maybe. Oh, maybe that's what happened. Okay, you should be able to see that now. Let me see if I can fix all of them. It's because one setting on one thing affects all of them, and I must have changed it at some point. Maybe in another course. I don't know. So you should be able to even get in for study attempts. Yeah, allow for study attempts, feedback, turn off this. You're supposed to get all the solutions. Okay, what you guys are doing is deciding which ones I'm going to do in class of the handout. All right, so these are due today as well. You should be able to study from the other ones, right? Is it true? How much time do you need for this assignment? Let's change some of the settings here. This one day you want? Connected some sort of update, so things. Oh. Oh, I called it a homework. Hmm. Yeah, I'm gonna have to fix this. All my settings are weird. Okay, so that one's okay. Hmm. It's like frozen. Anyway. Adamaris wants Saturday? Sure, I can leave it for Saturday. Okay, so I'll go through these and see what's going on. They're all weird. Everything's weird. I think it's because in another course, I might have changed the settings and it goes through all of them. Anyway, whatever. So I'm changing the connect assignment to. I have to make a note. I'll never remember. So you're gonna work hard this week on Unit 5, right? Should we continue, Adamaris? I'll just change this right now. So it's done. Because once it's closed, we're in trouble. I can't change anything anymore. Won't let me change the category. Saturday. I don't know, it's like frozen. I can't change it to be an exam. All right. Thank you. So let's see, back to which one am I going to solve for you? Which one is confusing? Look at the clave for risk and return review 1 and tell me which one you want me to solve. If you don't want me to solve one, I'll just go to the next material. Okay. So Abuelo Tomas has been receiving $30,000 yearly in retirement income, but has decided his future payments should be indexed for inflation. The actual cash received will increase according to the inflation rate. He estimates that expected inflation is 2% a year. They have further agreed that he will receive 20 index annual payments starting 1 year from today. Assuming the retirement fund is expected to earn an effective nominal rate of 12.2% per year, compute the amount in the fund today. So what type of problem is this? Which formula would I use for this? So this is just like the discounting and inflation exercise that we did. In this case, he wants to be indexed for inflation. He wants to maintain his purchasing power. So what formula would you use if you remember that? Annuity, but which one? Because you have with growth, that's right. So you got to use the annuity with growth formula. There you go. So this is precisely the formula, the discounting inflation handout. So you can do this with the nominal rate and the growing annuity, or the real rate where he wants to maintain $30,000 purchasing power. So you use the regular annuity formula with the real rate. Is that okay? You want me to keep that up? Make sense? So that's just the discounting inflation handout. So these all are like test type questions. These are the test type questions I can ask you. These are all from tests. I mean, which other one? I'll give you one more because I'm not going to step through it. You can punch that in. You want me to punch it in? Practice punching it in. You start. Yes, what, Carlos? You want me to punch it in? Or you want me to? I don't even remember what I asked. The calculate, okay. So let's do this. So I would start here inside this bracket. So 1.02 divided by 1.122 equals. Then I raise to the power of 20. Then I change the sign to -1 and I add 1. Make to negative. Now I have the entire bracket, this whole bracket here. This whole thing here. Not that, but the whole thing. It's hard to do this because I'm on my Safari screen. So I have the whole square bracket, and then I continue. I multiply by 30,000. I multiply by 1.02. And then I divide by 10%. Unless I made a mistake because it's not exact. Well, let's do it again. 1.02 divided by 1.122 equals to the power of 20 equals negative plus 1 times 30,000 times 1.02. Oh, I get the wrong answer. What did I do wrong? So is this why you're making me do it? Because it's the wrong answer? Oh, no, I see what I did wrong. It's not 10%. It's 1. I need my glasses. Okay, I took my glasses off for a minute. You're dividing by 0.102. There you go. Because I just divided by 0.1, not 0.102. Any other complicated one that you want me to do? So this one is just, this number 2 is just what we did with the normal distribution curve. Same thing. This one forces you, number 3 forces you to use the formulas to find an estimate of the average return and use it to predict returns, which is very practical. Number 4 uses the return formula, so you get to practice that. 5 is the dividend growth model. 6 is more statistics. 7 is the statistics again. And then some stuff on nominal and real rates. Wow, this is long. And then just a bunch of statistics that you should practice computing. And that's it. So this is all just applying those formulas on risk and return. So I'm going to leave it for you. And get back to the platform. I closed it. We're going to study now the new set of notes. So try all those exercises. Don't just read the answers, attempt them, and then verify, whether you got them right or wrong. Okay, capital asset pricing model. Just getting this ready. Okay. All right. So more statistics for you. So I'll read through these. So what we're going to do is what we've done so far is we've learned how to calculate a return over a period of time, and we've done it for historical data, right? And now I'm going to talk about calculating returns if you have ex-ante data, which I've already presented to you in the statistics review, but now we're going to apply it to returns data. Or we're going to continue to apply it to returns data. So to make good or value maximizing financial decisions, one must understand the relationship between risk and return. We accept the notion that investors like returns and dislike risk. Consider the following proxies for return and risk. We use the expected return as the weighted average of the distributions of possible returns in the future, and the variance of returns as a measure of the dispersion of the distribution of possible return in the future. So expected return and variance of returns or standard deviation for risk. So we've seen this already. This is where you have ex-ante type data. The expected return or the mean is a weighted mean. So we have to get the weighted average where these weights sum to 1. And you could do this in Excel. You can do it in a table type form, or I think I'd like to show you or remind you how to do this in your calculator, right? So we can do this. Remember, in your calculator in stat mode, you can enter this first column as your X and the second column as your Y, and you can get the sigma XY, like this, basically the weighted mean. So let's do that. I'm going to go to the data sheet and clear it up so it's just clean. And now I'm going to enter, make this a little bigger. Second data, I already turned it on. And I'm going to put into X 0.25, enter, scroll down, and there's one of them. But I'm going to also put its pair 0.05 negative, enter down. And now I'm with the weight again, so 0.5, enter down, and then I turn the percentage into a decimal, 5, enter down, and then 0.25, and oops, and 0.35, enter down. And I ask the calculator to give me statistics, and I use the up arrow to easily find the weighted mean. Did you see that? So it is 15%. Hans, did you get it? Did you try it? So then let's get the standard deviation. To get the standard deviation of the returns for ex-ante data, we have to get the weighted standard deviation. And so this is just the weighted standard deviation, just like I explained to you when we use the Greek letters for population type data, because this is showing me all the states of the world. This is like what's going to happen. It's a predictive model. So I treat it like it's going to give me all the only possible outcomes, which is basically the population. There's only 3 possible outcomes. Now, to estimate these numbers, past prices were used, fundamentals were looked at, other models that predict economic conditions. They came up with this distribution here, and we're going to use it to get, oh, where's the distribution? Let me get the distribution. This is the distribution. And it's a discrete distribution, and it's a simple one. It could be much more complex, but not in this class, not allowed. So those are the returns. And so the formula here for the variance is the deviation, squared deviation from the mean, the weighted square deviation from the mean, or the average of the square deviations from the mean. That's the better way to say it. In this case, it's the weighted average. So what I have to do is put in columns the weight, and then in this column, I put the deviation. So I take each of these values and I subtract by the mean each time. So I guess I could show you that. So that's how I explain to solve this manually. So what I said in the stats review is work in columns. So first I'm going to put the weight. So I'm just copying this. Just copying this here. And then I'm going to make brackets, put squares on them, and copy out the returns as decimals. And then put the mean here, which we know was 1.5. That's it. So I work in columns, add that up, and I'm done. That's my variance. And then I can take the square root to get the standard deviation. To do this on your calculator, you can use the store keys. You could say 0.05 negative minus 0.15 equals square times 0.25 equals store 1. So that's the first term. Well, something's going on because that's still there. Get rid of that. I'm going to do that again. 0.05 negative minus 0.15 equals squared times 0.25 equals, yeah. I'll store 1. And then the next one, 0.15 minus 0.1. So that's easy. That's just a 0. And then this one is also 0.01. That's actually very easy, this one. 0.35 minus 1.5 is 0.2 times 0.25. Oh no, squared. Okay, I did something wrong. 0.35 minus 0.15 equals squared times 0.25 equals 0.01. Okay. So then when you add them up, it's 0.02. And when you take the square root of that, you get this number. So the standard deviation is 14% and the mean is 15%. So within one standard deviation, you hit 0 pretty much in returns. So Okay, so let's go back. So for any individual stock, we don't do this normal distribution thinking, right? Just to clarify that. It's only for a portfolio of well-diversified stock that we do that. Okay, so what I did was calculated this number here. And then, all right, so we've got the mean and standard deviation, where mu was equal to 15%, and the standard deviation is 14%. So that's how we dealt with one security, and that's just a review. If you followed the statistics review, this is just a review of that. And what about two assets? What are the statistics for two assets? So this is relatively new. So the other stuff was just using, until this moment, I've used all the statistics that I reviewed in the stats review, and now I'm doing something new and hoping that we can lean on your understanding of statistics to do this. I want to create what's called a joint probability distribution, but I'm not going to be so fancy in my terminology. I want to know if we have two assets and they're held together in a portfolio, what are the return and standard deviations of that portfolio? And then we're going to move to more general, more than two assets case, which is more realistic. People don't just hold two assets if they're investing in risky assets. They hold a bundle of them, right? A portfolio of them. So let's see. With this information I have on asset A and asset B, before I begin, let's just look at them. And what do you see? What is their relationship? Is there a relationship? What's the relationship? What would you say is the relationship? No comments. Well, what you see is when A's returns are high, B's returns are low. And I'm saying, relatively speaking, here are the averages for A, and here's the average for B. So on average, A's returns are 6%. On average, B's returns are 7%. So when I see 30%, that's relatively high for A. And I see negative 20%, that's relatively low for B. So I say, when A is high, B is low. When A is low, B is high. They are inversely related or negatively correlated. It doesn't mean that asset A is causing B to do that, but the factors that determine the returns on asset A have the opposite effect on asset B. Now, this is an interesting combination because you'll see that each asset acts as a buffer or a hedge against the downside of returns for the other asset. Okay, so what's going to be the effect of that? Let's do the math. So here's the average returns. Let's get the standard deviation. So I have to calculate the variance and standard deviation, and here they are. The standard deviation for A is 19.6 and for B is 22%. So these are quite high, but relatively speaking, looking here, I've summarized them here. You can practice making the calculations later. Always will be like what, Daylene? oh, no, that they're negatively correlated. No, not at all. They could be positively correlated, but I picked these to show you something. Yeah, good question. So when I look at these two and I was considering holding asset A or holding asset B, which one should I hold? Asset B has a higher return, but look at that risk. So if we think about that's shooting us into the negatives, just as this one for A is. So how do I know which one to pick? Because there's a trade-off here. The one with the higher, it's unclear. There's a trade-off. And so when there's a trade-off, the one with the higher return also has a higher risk. We have to think about our risk tolerance. What are we ready? What are we interested in? What's our goal? Well, if you're a risk averse investor, then when presented with two securities with comparable returns, we'll choose the one with lower risk. In this case, they're comparable, they're very similar, but they're not the same. Okay, so we have to figure out a way to be able to make them comparable. Just another point, risk-loving investors, when presented with two securities with comparable returns, will choose the higher risk security. So here we have our data, our statistics about A and B. I'm going to introduce a new statistic. So far, everything has been, I'm just repeating what we've done before, but I introduced now a new statistic. This is called the coefficient of variation. And it is the way we can cut through the risk-return trade-off and come up with a conclusion about what to do in this case. So this is like a measure of risk, and this is a measure of return, right? So in other words, this is the cost, and this is the benefit. You can think of it like that. So what we're going to do is divide the cost over the benefit to measure the risk per unit of return, per unit of benefit. So when we do that, we get 3.27 for A, but we only get 3.14 for B. So which one is more risky? It's the higher valued one. I mean, the higher coefficient of variation one. For each unit of benefit, you have to pay a higher price than you would here in B. So what does it mean? Now I've translated everything into a single index and that I can compare. Now they're comparable stocks. So risk-averse investors will choose B instead of A. Risk-loving investors will choose A instead of B. Questions? So I've shown you two securities. We've calculated the statistics for them as ex-ante data returns. And then I want to compare them, which one is better. And depending on who you are, your risk tolerance, you all choose A or B. And we use the coefficient of variation to help us. And now the new stuff, combining two assets into a portfolio. To combine two assets in a portfolio, we are going to think about something like this. Consider putting two assets in a portfolio where 50% is invested in A and 50% in B. So for instance, for example, $1,000 investment is $500 in A and $500 in B. So this is 50% A and that is 50% B. So those are the weights I'm talking about now. Before it was the weights, the state of the economy weights, right? But this is different. This is taking the expected returns 6 and 7 and combining them into a return for P, the portfolio. So this stands for portfolio. And what am I doing here? This is a rule. This rule comes from statistics, obviously. It's saying that where RP is equal to a weighted average of the returns of, oops, I gotta fix that, of A and B and I want to find the expected returns of the new security, I can do that by just the, well, take it a step back. So this is like, we call it like an operator. How does it act on these variables? So the returns to A, that's the variable RA, returns to B, that's the variable RB, and I have a weighted average. So if I have a weighted average, is the expected return of the weighted average of the expected returns? Basically the question here. Uh-oh, this is black background. What happened? I can give you an example to, let's just give an example to show you what I mean. So okay, so these are the returns. I just made them up for asset A and B. And now let's create RP. RP is just adding them. So if I have RP, I have both of them, so I should get both of their returns. So let's compute RP. Okay, but RP, I'm going to put a little bit of each in. Let's just do the 50-50 because it's easy, right? So 0.5 RA plus 0.5 RB. So in other words, I'm just averaging RA and RB. Do you agree? So the average between 2 and 1 is 1.5. And between 5 and 6 is 5.5. And between 3 and 10 is like 6.5. And between 8 and 7 is 7.5. That was easy enough. Okay. So now the question is, well, find the average of all of these. Use your calculator and get me the average of RA, the average of RB, and the average of RP, and I'll make my point. You guys still there? I'm so tired, but I'm trying to stay awake to show you this, and I'm going to leave you to have it all unfold for you, hopefully. Okay. So for RA, you said 3.5 is the average. RB, the average was 6. And then RP, 4.5. And then RP is 5.25. So these two, if you add these and divide by 2, do you get 5.25? That's the question. So we did it adding them this way and we got 5.25, but could we have gotten it by doing 4.5 plus 6 divided by 2? Yes. So what did we show? We showed that the average calculated the long way is the same as just doing the average of the ones we already know. Okay, so what we've proven is that the average of a sum or a weighted, okay, sorry, okay, I'll say it like that. The average of a weighted sum is the sum of the weighted average. So I just proved it to you there. You accompanied me with that description. And basically, down here, I'll write it. So the expected value of XA RA plus XB RB. Essentially, visually, I can just put the E in front here. So the weighted average of the variables is the same. The average of the weighted sum, weighted average, is just the sum. So I do this without confusing you. So this is the mean of the weighted sum is the sum of the weighted means. That's the way to say it. That clear? Mean of the weighted average is the weighted average of the means. Okay, so basically, yes, I can just move the E to the variable. Remember, XA is a number. It's just 0.5. It's nothing fancy. So E just goes to here and here. And in our exercise, we need to calculate it. So I go through the steps to calculate it. And I get we can just get it with the weights that we have, right? We already have, this is 0.5. We know that. And RA, remember, was 6%. And then this is 0.5 and RB is 7%. So the weighted average of 6 and 7 is just 6.5%. So in other words, we don't have to go the long way. We can just use the already available data and average it. So what about the standard deviation? I'll talk about this and then let you go and have fun making calculations. The standard deviation is the square root of the variance, and the variance is this very apparently long formula. So this is new as well. And notice something is, so we learned here that the expected value of the weighted average of the two returns is just the weighted average of the two means. Is it the same way for the variance? That's the question. And here I answer it. It looks like this is, so ignore this term for a moment and just look here. So this is like a weighted average of variances, but my weight got squared. And the reason the weight got squared is because, remember, I squared all values when I calculate the standard deviations from the mean squared to calculate the variance. And again, go back and watch the statistics videos to see my explanation about variances. So statistics is all about means and relative measures. You have to, once you see the pattern, it's all going to be easier for you. So I recommend you go back and watch those videos. So so this looks like a weighted average. Again, ignoring this term. I'm going to white it out. Oh no, what I'm going to do is I'm going to copy it over here and say that this is true. That the standard deviation of a portfolio of X and A with a weight of A and a weight of B denoted by XA and XB is just the weighted average, but the weights get squared because everything gets squared with the variance before we take the square root, remember? So I do have in my video, I explain that as well. So this is true. Let me say it like this. If acid A and B are not correlated, in other words, sigma AB is equal to 0. So then this last term disappears because that'll be 0. So it's very simple when there's no correlation between two assets. So which assets would not be correlated? I talked to you about the risk-free asset, remember? T-bills are not correlated with risky assets because T-bills in our assumptions of risk-free, the risk-free asset, T-bills have no volatility, so they don't vary. No matter what's happening, T-bills will pay their constant return. All right, so T-bills are not correlated with assets, risky assets. So that's just an example. In our case, I showed you they were negatively correlated. So this term does exist, and you'd have to calculate it. So this variance, I explain how I get this formula in the videos for CAPN, and how you find the mean and standard deviation for more than 2 assets. So work through these notes, work with the videos to see the explanation of what I do, and don't be intimidated by these formulas. Always go back to the first sheet I gave you with the formulas just as X's and Y's to remind yourself of what this all means, right? The covariance, these are just the deviations from the mean. It just looks really long and wordy, trying to be precise, but it can unfortunately confuse instead of clarify. So, so what we found here is the formula for the variance of the portfolio of assets, of risky assets, on the 2 assets. So I'm going to stop here. It is, but watch the video, okay, Darlene? And if you want to meet, I don't know when that can be possible. I'm trying to think. Well, watch all the videos because I'm on there and I'm explaining all these notes to you. So if you want to meet, probably the only time is Thursday. I don't know if you can watch everything by Thursday, but I'll let you go early. Maybe you can spend tonight learning exactly what I had to say here. And that's basically it. This explains the formula, and then I just apply the formula. I talk about some results, and here as I use that variance formula, but just see it as an exercise, an example, because what I do is I on this slide, I should tell you right now that there's this is slide 21. All that I forgot to do here is I'm supposed to multiply these together, and somehow I missed it in here. It doesn't ruin any of the numbers, just in case you're trying to validate these numbers. That should be also multiplied by this number 2. So I multiply by that, but then I have to multiply by 0.012. So that creates this set of possibilities, and this is what I'm going to talk about. This is risk, and this is return for the portfolio. And what we're interested in is looking at all the possible combinations between 2 assets. Asset Z, which is low risk and low return, and asset Y, that's high risk and high return. So if you guys feel I need to slow down, let me know. And I'm going to try and I'm going to ask you to watch all the videos for Saturday. I can give you more time than Saturday if you need to complete the assignment. You just have to let me know. But I really don't want to talk about this stuff too much. If we get together next week, I mean, we're going to get together next week, next Tuesday. I would like to be solving problems rather than talking about it. So watch all the video introduction, and then we can solve problems next week. And I will delay the assignment into like Tuesday or something. I won't go to the whole next weekend. How's that sound? I know you have other classes and lots to do. I'm doing the basic here with finance. Okay, so I'm going to say good night because my eyes are closing. I can't imagine how you're doing over there. It has to be worse. So watch the videos, be fresh, and then next week I'll have the assignment due on like Wednesday night or something, and hopefully you're going to make it through most of it, and you can just ask me questions as you go along. Okay. The second test grades are not ready yet, Julio. Yes, Dylan, all the videos are on the platform, right? But yeah, I'll put it up. I mean, I don't want to give you more videos, but yeah, I'll put it up so you can remember this one in particular. I think this little chart that we did here is really important. I don't think I did that in the other video where we just added numbers together. This thing here to prove my point. Okay. All right, so we'll see you next week and we'll be in touch. Bye.